question about a major financial inclusion initiative in India. We're focusing on the official slogan of the Pradhan Mantri Jan Dhan Yojana. This program aims to bring banking to every household, and the slogan captures its spirit. Think about which phrase best represents this vision. Let's take a closer look at the official slogan of the PM Jan Dhan Yojana, Mera Khata Bhagya Vidhata. It captures the spirit of the initiative, emphasizing how opening an account can change one's destiny. By March 2025, around 55 crore accounts had been opened under this scheme, a massive step toward financial inclusion in India. This slide highlights the scale and impact of the program, setting the stage for deeper discussion ahead. Let's look at the second question. It asks how many sectors are covered under the Make in India initiative, which was launched back in 2014. The options range from 15 to 30 sectors. This initiative aims to boost manufacturing and attract investment across multiple industries in India. Understanding the scope helps us see the scale and ambition behind the program. So, how many sectors do you think are included? Let's take a closer look at the Make in India scheme. Launched back in 2014, it focuses on 25 key sectors. The goal? To boost manufacturing and attract investment across the country. This initiative is about building a stronger industrial base, creating jobs, and encouraging innovation. By targeting specific sectors, it aims to make India a global manufacturing hub. It's a strategic move to transform the economy and open new opportunities. Let's test our knowledge with a quick question. The Bidi Bakau Bidi Padhouse scheme, which city was it officially launched in? Was it Jaipur, Panipat, Lucknow, or Ahmedabad? Think about the significance of the launch location and what it might tell us about the initiative's focus. This question helps us connect the program to its roots and the communities it aims to impact. Let's take a closer look at the scheme, which was launched in Panipat, Haryana, on January 22, 2015. The goal was clear: to tackle the declining child-sex ratio in the state. This initiative aimed to bring awareness and change where it was urgently needed. Understanding the context and timing helps us see why this program was so important for Haryana. Let's take a look at the current interest rates offered under the Sukanya Samriddhi Yojana. The options range from 6.5% up to 9%. Specifically, the choices are 6.5, 7.1, 8.2, and 9%. Our goal here is to identify which one is closest to the actual rate according to the source. This question helps us understand the financial benefits of this savings scheme. Let's take a closer look at the Sukanya Samriddhi Yojana. Right now, it offers an interest rate of about 8.2%. This rate isn't fixed, it changes over time, adjusting to factors like inflation or deflation. So the returns you get can go up or down depending on the economic climate. This flexibility helps keep the scheme aligned with current financial conditions. Understanding this rate is key to making informed decisions about the plan. Let's take a closer look at the categories within the Mudra loan scheme. We've got Shishu Plus, Kishore Plus, Tarun Plus, and Micro Plus. Now, here's the question: which one of these was added most recently? This helps us understand how the scheme is evolving to meet new needs and support different stages of business growth. Think about the options carefully before we move on. Let's take a closer look at how Mudra's loan categories have evolved. Originally, there were 3, Shishu, Kishore, and Tarun, each designed to serve different stages of business growth. Recently, a 4th category called Tarun Plus was introduced. This new category allows for larger loans, up to 20 lakh, expanding support for growing enterprises. This change reflects a deeper understanding of entrepreneurs' needs as they scale. Let's look at the age eligibility for the Atal Pension Yojana, or APY. This question asks which age range qualifies to join the scheme. The options vary from 18 to 60 years, 18 to 40, 21 to 50, and 25 to 45 years. Understanding the correct age range is key. It tells us who can start contributing and benefit from this pension plan over time. This helps us grasp how the program targets different age groups for long-term financial security. Let's take a closer look at the APY, or Atal Pension Yojana. This scheme is designed specifically for the unorganized sector, people who often don't have formal pension plans. To be eligible, contributors need to be between 18 and 40 years old. This age range ensures they have enough time to build a meaningful pension. It's a targeted effort to bring financial security to those who need it most. Let's look at the annual premium for accidental insurance under the PM Suraksha Bima Yojana. This question tests our knowledge of the exact amount one needs to pay each year to be covered. The options range from as low as 12 rupees to as high as 500. Knowing the correct premium helps us understand the scheme's affordability and accessibility for the common person. Let's keep this in mind as we explore further details. Let's take a closer look at the PM Suraksha Bima Yojana. It's an accidental insurance scheme designed to provide coverage at a very low cost, just 12 rupees a year. This makes it accessible to a wide range of people, especially those who might not otherwise afford insurance. The focus here is on simplicity and affordability, ensuring protection against accidents without a heavy financial burden. This slide highlights why option B is the correct answer. Let's look at a quick quiz question to test what we've learned so far. Which state was the first to submit its State Annual Action Plan under the AMRUT scheme? The options are Gujarat, Rajasthan, Maharashtra, and Uttar Pradesh. Think about the progress and leadership each state has shown in urban development initiatives. This question helps us see which region took the lead in this important program. Let's look at a key milestone in urban development. Rajasthan was actually the first state in India to submit its annual action plan under the Atal Mission for Rejuvenation and Urban Transformation, or AMRUT. This shows their early commitment to improving urban infrastructure and quality of life. It's an important example of leadership in implementing national initiatives at the state level. Let's look at who the PM Ujjwala Yojana primarily aims to help. The options include all rural households, urban slum dwellers, below poverty line households, and small-scale farmers. This scheme focuses on providing LPG connections to those who need cleaner cooking fuel the most. Think about which group faces the biggest challenges with traditional fuels and would benefit most from this initiative. We'll explore the answer and why this target group was chosen. Let's take a closer look at this scheme. It's designed to provide LPG connections specifically to households eligible under the below poverty line category. By March 2025, more than 10 crore connections have been distributed through this initiative. This massive scale shows the program's reach and impact in bringing cleaner cooking fuel to millions of families who need it most. Now, let's look at the financial support offered to farmers under the PM Kisan scheme. The question asks about the annual benefit amount provided to eligible farmers. The options range from 2,000 to 10,000 rupees. Understanding this figure is key to grasping how the scheme supports agricultural livelihoods and contributes to rural income stability. Keep this in mind as we explore the impact of such initiatives. Let's break down how the payment works for eligible farmers. They receive a total of 6,000 rupees every year. But that amount isn't handed over all at once. Instead, it's split into 3 equal parts, 2,000 rupees each time. This way, the support is steady and spread out, helping farmers throughout the year. Understanding this schedule is key to grasping the program's structure and how it benefits those it's designed to help. Let's look at a question about the NIRVIK scheme. It asks which sector this initiative mainly supports. The options are agriculture, export promotion, rural housing, and digital literacy. We're focusing on understanding where the scheme's impact is strongest, which area it's designed to boost or develop. This helps us see how targeted policies work to support specific parts of the economy or society. Let's take a closer look at the NIRVIK scheme. It's designed to support exporters by providing loans and credit guarantees. The goal here is clear: to boost export promotion by making financing easier and less risky. This initiative helps businesses access the funds they need to grow internationally by reducing the financial barriers that often hold them back. It's a targeted approach to strengthen exports through better credit support. Let's look at a key date in rural development, the launch of the SVAMITVA scheme. This initiative focuses on property ownership in villages, aiming to provide clear land records and empower residents. The question here is, when exactly did this scheme start? We're given 4 options, ranging from 2014 to 2020. Knowing the correct launch date helps us understand the timeline of this important government effort. Let's dive into the SVA-MITVA scheme. It was launched on Panchayati Raj Day, April 24, 2020. The goal? To provide property cards and officially document ownership in rural areas. This initiative helps bring clarity and security to landowners, empowering communities with legal proof of their property rights. It's a big step towards strengthening rural governance and boosting development at the grassroots level. Let's talk about PMWANI, an initiative aimed at boosting connectivity. The question here is, what exactly does it focus on? Is it rural roads, public Wi-Fi networks, canal irrigation, or railway tracks? The key idea behind PMWANI is to expand internet access, especially in areas that need it most. So, think about which of these options best fits that goal. This helps us understand how infrastructure projects can directly impact digital inclusion. Let's take a closer look at PMWANI, which stands for Public Wi-Fi Access Network Interface. It was launched in December 2020 with a clear goal, to boost wireless connectivity across the country. This initiative aims to make both business and everyday life easier by expanding access to public Wi-Fi. It's a step toward more seamless, affordable internet access for everyone, helping bridge the digital divide and supporting economic growth. Now we're looking at the Bima Trinity, a key concept under IRDAI's 2047 vision. This trinity includes 3 specific components that work together to strengthen insurance coverage. The options mix different schemes and categories, but the correct trio focuses on Jan Dhan, Bima, and pension. These 3 form the foundation for inclusive insurance, aiming to secure financial futures across India. Understanding this helps us see how policy goals translate into real-world protection. To make insurance accessible to everyone by 2047, we rely on 3 key components: Bima Vahak, Bima Vistar, and Bima. Together, these form what we call the Bima Trinity. Each part plays a crucial role in expanding coverage, simplifying access, and ensuring that no one is left behind. This approach is central to turning the vision of insurance for all into a reality. Now, let's focus on a key milestone in housing policy. The question asks about the original target year for achieving housing for all under the Prime Minister's Awas Yojana. The options range from 2020 to 2030, with intermediate years in between. This question helps us understand the timeline set for this ambitious initiative and how goals were structured to address housing needs across the country. Let's take a closer look at the PM Awas Yojana, launched back in 2015. Its main goal was simple but ambitious, to provide affordable housing for all by the year 2022. This slide focuses on the economic acts connected to that mission. Understanding these policies helps us see how the government planned to make housing accessible and affordable across the country. It's a key part of the bigger picture we're exploring today. Let's look at a key moment in India's financial history. The question asks, when was the first Income Tax Act introduced by James Wilson? The options range from 1860 to 1961, with notable years like 1881 and 1922 in between. This question helps us understand the origins of income tax in India, marking a significant step in the country's economic development. Keep these dates in mind as we explore how taxation evolved over time. Let's take a closer look at the history of income tax in India. Many people point to the 1961 Act as the starting point, but the story actually begins much earlier. The first income tax was introduced way back in 1860 by James Wilson. This earlier act laid the groundwork for what would eventually evolve into the modern tax system we know today. Understanding this helps us see the full picture, where it all really started. Let's take a moment to consider the year when the Reserve Bank of India Act was passed. This question gives us 4 options: 1934, 1935, 1949, and 1950. Each of these years marks significant moments in India's financial history. Our goal here is to pinpoint the exact year that laid the foundation for the RBI's legal framework. Think about the context of India's economic development during that period as we decide the right answer. Let's take a closer look at the RBI Act. It was passed in 1934, which set the stage for something big, the creation of the Reserve Bank of India. The central bank officially came into existence on April 1, 1935. This moment marked a major milestone in India's financial history. So when we talk about the RBI's origins, this date is key. The correct answer here is option B. Let's look at the maximum coin denomination the Government of India can mint under the Coinage Act of 2011. The options range from 100 rupees up to 10,000 rupees. This question tests our understanding of the legal limits on coin values, which is important for grasping how currency regulations shape everyday transactions and the economy. Think about which of these denominations is actually allowed for coins by law. Let's take a closer look at the Indian Coinage Act of 2011. This law gives the government the power to mint coins, but only up to a certain limit. Specifically, coins can be issued up to a maximum value of 1,000 rupees. That's an important detail when we think about currency design and regulation. So, when asked about the highest denomination allowed for coins under this act, the correct answer is clearly option C. Now, let's focus on an important milestone in labor rights. When exactly was the Minimum Wage Act passed in India? The options range from 1947 to 1960. This question helps us understand the timeline of worker protections and economic reforms in the country. Think about the context of post-independence India and the efforts to improve living standards through legislation. Keep this date in mind as we explore how labor laws evolved over time. Let's take a closer look at the Minimum Wage Act. Passed in 1948, right after independence, this law plays a vital role in protecting workers. It sets the lowest pay employers can offer, ensuring fair wages across industries. Understanding this act is key to grasping labor rights in our country. The correct answer here highlights its importance as a foundational piece of labor legislation. Let's take a moment to test what we've learned so far. Here's a multiple-choice question about the State Bank of India. The question asks, in which year was the Imperial Bank of India renamed the State Bank of India? 4 options are given: 1921, 1950, 1955, and 1969. Think about the historical context and pick the year that fits best. This helps us connect dates with key events in banking history. Let's take a closer look at the transformation of a major financial institution in India. The Imperial Bank of India, which was established back in 1921, underwent a significant change when the SBI Act was passed in 1955. This legislation marked its transition into what we now know as the State Bank of India. Understanding this shift helps us see how historical developments shape the institutions we rely on today. The correct answer here is option C. Let's take a moment to focus on a key date in Indian history, the year the Food Corporation of India was established. This question asks us to identify that year from 4 options: 1955, 1960, 1965, and 1970. It's important because the FCI plays a crucial role in managing food security and supply across the country. Knowing when it was founded helps us understand the timeline of India's efforts to stabilize food distribution after independence. Let's take a closer look at the origins of 2 key institutions in food management. Both the Food Corporation of India and the Agricultural Price Commission were set up in 1965. Their main roles: managing food security and controlling pricing to ensure stability. This background helps us understand why option B is the correct answer in this context. It's all about the foundation these organizations laid for the system we study today. Let's look at how some key laws have evolved over time. The MRTP Act from 1969 was an important step in regulating business practices, but it didn't stay in place forever. Eventually, it was replaced by one of these acts: the SEBI Act, the Competition Act, FEMA, or FERA. This question helps us understand which legislation took over to address market regulation and competition in a more modern context. It's a crucial piece of the puzzle in India's economic framework. Let's take a closer look at how India's approach to regulating competition evolved. The Monopolies and Restrictive Trade Practices Act was the old framework, but it was replaced by something new: the Competition Commission of India, or CCI. This change came with the 2002 Act, marking a shift towards a more modern and effective system for overseeing fair competition in the market. The CCI now plays a central role in keeping markets competitive and protecting consumers. Now, we're looking at a question about the NABARD Act, passed in 1981. The key point here is understanding which committee recommended setting up the institution. The options include the Narasimhan, Shivraman, Tarapur, and Gadgil committees. Each played a role in different areas, but only one directly influenced the creation of NABARD. This question helps us connect policy decisions to the committees behind them. Let's take a closer look at NABARD. It was established on July 12, 1982. This came after the 1981 Act and the recommendations made by the Shivraman Committee. Understanding this timeline helps us see how policy and expert advice shaped its formation. It's a key piece in the puzzle of how the institution came to be. Let's look at a key moment in financial regulation. The question asks, when did the SEBI Act officially give statutory powers to the Securities and Exchange Board of India? The options range from 1988 to 1995. This is important because it marks when SEBI gained legal authority to regulate and protect investors, shaping India's securities market. Understanding this year helps us track how financial oversight evolved in the country. Let's take a closer look at SEBI's authority. While SEBI was around before, it wasn't until the SEBI Act of 1992 that it gained formal legal powers. This act gave SEBI the statutory authority it needed to regulate the securities market effectively. So, when we talk about SEBI's real power, it all comes down to that 1992 legislation. The correct answer here is C. Let's take a moment to focus on the Fiscal Responsibility and Budget Management Act, or FRBM Act, which is key to managing government finances. This question asks us to identify the year it was enacted. The options range from 2000 to 2010. Knowing the correct year helps us understand the timeline of fiscal reforms and their impact on economic policy. Keep this in mind as we move forward. Let's take a closer look at the Fiscal Responsibility and Budget Management Act, or FRBM Act, which was put into place back in 2003. Its main goal is to keep government finances in check, to promote fiscal discipline and prevent excessive borrowing. This law sets clear targets for reducing deficits and managing debt, helping maintain economic stability over time. Understanding this act is key to grasping how fiscal policy works in practice. Let's look at a question about special economic zones, or SEZs, in India. We're asked which state has the largest number of operational SEZs. The options are Gujarat, Maharashtra, Tamil Nadu, and Karnataka. This question helps us understand regional economic hubs and where these zones are most concentrated. It's a key point for grasping how different states contribute to trade and investment through SEZs. Let's take a closer look at the distribution of special economic zones across India. Tamil Nadu leads the way, hosting the largest number with about 54 operational units. That's out of a total of 280 SEZs nationwide. This detail helps us understand the regional economic landscape and where industrial growth is most concentrated. It's a key point in grasping the broader picture of India's development strategy. Let's look at a key moment in social policy, the official start of the MGNREGA program. This question asks us to identify the year it began functioning. The options range from 2004 to 2008, covering a few years in the mid-2000s. Knowing the exact year helps us understand the timeline of this important initiative and its impact on rural employment. It's a straightforward question, but one that anchors the program in its historical context. Let's take a closer look at the timeline of the MGNREGA Act. Although the Act itself was passed in 2005, the actual implementation, the day-to-day operations, didn't start until February 2006. This distinction matters because passing a law and putting it into action are two different steps. Understanding when the program truly began helps us track its impact and progress accurately. The correct answer here is C. Let's look at the official launch date of the Goods and Services Tax, or GST, in India. This question asks us to pinpoint exactly when GST was implemented. Was it April 1st, July 1st, August 15th, or January 1st of 2018. Knowing this date helps us understand a major shift in India's tax system, a moment that reshaped the economy in a big way. Take a moment to think about it. Let's take a closer look at GST Day. The Goods and Services Tax, or GST, was officially rolled out on July 1st, 2017. Since then, this date has been marked annually as GST Day. It's a way to recognize the impact of this major tax reform. Remember, the correct answer here is option B. That's the key fact to keep in mind. Let's take a moment to focus on a key milestone in economic reform, the Insolvency and Bankruptcy Code, or IBC. This question asks us to identify the year it was introduced. Was it 2013, 2014, 2015, or 2016? Understanding when the IBC came into effect helps us appreciate its role in reshaping how insolvency is handled in the economy. Think about the timeline and the impact this reform has had since its introduction. Let's take a closer look at the IBC, or Insolvency and Bankruptcy Code. It was introduced in 2016 to simplify how we handle businesses that can't pay their debts. Then, in 2019, it was updated to make the process even smoother. This slide highlights those key changes, showing how the law evolved to better support insolvency resolution. The correct answer here reflects that timeline and purpose. Let's look at a question about the Consumer Protection Act. The original act was passed in 1986, but it was replaced by a newer version. The question asks, in which year did that happen? The options range from 2017 to 2021. This is about understanding when important legal updates took place to better protect consumers in today's world. Let's take a closer look at the Consumer Protection Act of 2019. This law replaced the older legislation from 1986, updating how consumers are protected in today's economy. In particular, Part 3 deals with economic theories that shape the rules and guidelines. Understanding this helps us see why certain answers, like option C, are correct when applying the law. It's about connecting the theory to real-world protections for consumers. Now, let's look at a question about economic thinkers. Who wrote the Tableau économique in 1758? This is a key concept in early economic theory. The options include Adam Smith, François Quesnay, David Ricardo, and J.S. Mill. Think about which of these figures is most closely linked to that foundational economic model. It's a great way to connect names with their ideas. Let's take a closer look at the Tableau économique, one of the earliest economic models ever created. Developed by François Quesnay back in 1758, it laid important groundwork for understanding how wealth flows through an economy. This model helped shape economic thought by illustrating the relationships between different sectors. Recognizing its significance, we see why this answer stands out as the correct one in this context. Let's look at a key moment in intellectual history. Adam Smith's theory of moral sentiments laid the groundwork for much of modern economic and ethical thought. But when exactly was it published? Was it 1759, 1776, 1789, or 1817? Think about the context of the 18th century. The Enlightenment was in full swing, shaping ideas about society and human nature. This question helps us place Smith's work in that timeline. Before Adam Smith wrote his groundbreaking work, The Wealth of Nations, he first explored human behavior and ethics in The Theory of Moral Sentiments, published in 1759. This earlier book laid the foundation for his later ideas about economics by focusing on how people relate to one another and make moral judgments. Understanding this helps us see Smith not just as an economist, but as a thinker deeply interested in the social fabric that underpins markets and society. Let's talk about the idea of comparative advantage, a cornerstone of international trade theory. The question here asks who first proposed this concept back in 1817. It's a key moment in economic thought, shaping how countries understand the benefits of trading with one another. Among the options, one name stands out as the pioneer behind this theory. We'll explore that answer and why it matters as we move forward. Let's take a closer look at the origin of the comparative advantage theory. It was David Ricardo who introduced this idea back in 1817 in his book titled Principles of Political Economy and Taxation. This theory helps explain how and why countries benefit from specializing in certain goods or services. Understanding this foundation is key to grasping the bigger picture of international trade. The correct answer here is option B. This question asks us to identify who is linked to the iron law of wages and the idea that population grows faster than food supply. The theory suggests that population increases geometrically, while food production only grows arithmetically. Among the options, Thomas Robert Malthus is the key figure behind this concept. His work highlighted the potential limits of resources in relation to population growth, a foundational idea in economics and demography. Let's take a closer look at Malthus and his ideas. In 1798, he published an essay on the principle of population. This work laid out his observations about how populations tend to grow, often faster than the resources available to support them. Understanding these growth trends is key to grasping the challenges he highlighted. This slide points us to the correct answer, emphasizing the importance of Malthus's original essay in the discussion. Let's look at a key question about economic laws. It asks which law is built around the idea that supply creates its own demand. This concept points us toward one specific economic principle. We have 4 options here: Keynes' law, Say's law, Gresham's law, and Engel's law. The right answer helps us understand how production and consumption interact in the economy. Keep this idea in mind as we explore the role of supply and demand in economic theory. Let's take a closer look at Say's law, named after the economist J.B. Say. It suggests that supply creates its own demand, that production drives consumption. But this idea didn't go unchallenged. Later, Keynesian economics questioned it, arguing that demand can sometimes fall short, causing economic slowdowns. On this slide, the correct answer is B, highlighting the importance of understanding these contrasting views in economic theory. Let's look at a key figure in economics, the person often called the Doctor of Economics. This individual wrote a foundational book titled Principles of Economics back in 1890. The question here is, who is this influential economist? We have 4 options: Leon Walras, Alfred Marshall, Vilfredo Pareto, and A.C. Pigou. Think about their contributions and who fits this description best. This question helps us connect names to their lasting impact on economic thought. Alfred Marshall, often known as the Doctor of Economics, played a key role in shaping modern economic thought. In 1890, he formalized the concept of marginal utility, the idea that the value of a good depends on the additional satisfaction it provides. This insight helped us understand how people make choices, and it remains a cornerstone of economic theory today. So, when we talk about marginal utility, we're really standing on Marshall's shoulders. Let's look at a key figure behind the kinked demand curve model of oligopoly, introduced in 1939. This concept helps explain how firms in an oligopoly might react to price changes by their competitors. The question here is, who developed this model? Was it Joseph Schumpeter, Heinrich von Stackelberg, Paul Sweezy, or Augustin Cournot? We'll explore their contributions and find out which one is credited with this important idea. Let's take a closer look at the king, or kinked, demand curve. Paul Sweezy came up with this idea back in 1939 to explain why prices often stay rigid in oligopolies, markets dominated by just a few firms. The curve shows how firms react differently to price increases versus decreases, which leads to this stickiness. Understanding this helps us see why prices don't always change, even when costs or demand shift. It's a key concept in studying competitive behavior. Here's a question that takes us back to a landmark moment in economic theory. The Theory of Games and Economic Behavior, published in 1944, was co-authored by Oscar Morgenstern and another key figure. Which of these thinkers worked alongside him? The options are Kenneth Arrow, Paul Samuelson, John von Neumann, and John Nash. Think about who helped lay the foundation for game theory as we know it today. Let's take a closer look at this foundational work in game theory, published back in 1944 by von Neumann and Morgenstern. Their research laid the groundwork for how we understand strategic decision-making today. This slide highlights the correct answer to a key question about their contribution, emphasizing just how pivotal their work has been in shaping the field. Let's talk about a key figure in economic theory, the developer of the general equilibrium concept. This theory, which explores how supply and demand balance across multiple markets simultaneously, was introduced in a landmark work called Elements of Pure Economics back in 1874. The question is, who is behind this groundbreaking idea? We're looking at four economists: Leon Walras, Adam Smith, David Ricardo, and Carl Menger. One of them laid the foundation for this important theory. Let's take a closer look at general equilibrium analysis. Leon Walras is widely recognized as the pioneer who introduced this concept back in 1874. His work laid the foundation for understanding how different markets interact and balance each other out simultaneously. This idea changed the way economists think about the economy as a whole, not just individual parts, but the entire system working together. It's a key milestone in economic theory, and that's why Walras gets the credit here. Now, let's talk about the two-gap model in development economics, introduced back in 1966. This model helps explain some key constraints countries face when trying to grow economically. The question is, who proposed this model? The options include Arthur Lewis, W. W. Rostow, Hollis Chenery, and Harrod and DeMar. Each of these economists made important contributions, but only one is behind the two-gap model. Let's see if you can pick the right name. Let's take a closer look at the two-gap model, developed by Hollis Chenery back in 1966. This model focuses on two key obstacles that can slow down economic growth: the savings gap and the foreign exchange gap. Understanding these gaps helps us see where a country might struggle to finance its development. It's a foundational concept in development economics, and it's important to keep in mind as we explore solutions. The correct answer here is option B. Let's look at the Phillips curve, introduced back in 1958. This concept explores the relationship between two key economic variables. It's not about income and consumption, or savings and investment, nor does it focus on supply and demand. Instead, the Phillips curve describes how inflation and unemployment interact, showing us that when one goes down, the other tends to go up. This idea has shaped how economists think about balancing these two important forces. Let's take a closer look at A.W. Phillips' work from 1958. He discovered an inverse relationship between inflation and unemployment, meaning, as one goes up, the other tends to go down. This insight shaped much of economic thinking for decades. Understanding this trade-off helps us grasp how policymakers balance these two crucial factors in managing an economy. Now, let's look at a key figure in economic theory. The question asks who proposed the permanent income hypothesis back in 1957. This idea changed how we think about consumer spending over time. Among the options, Milton Friedman is the economist behind this hypothesis. It suggests that people base their consumption not just on current income, but on their expected long-term average income, their permanent income. This insight helps explain why spending patterns don't always shift dramatically with short-term income changes. Let's take a closer look at two important economic ideas from the mid-20th century. Milton Friedman introduced his hypothesis in 1957, focusing on how people manage their money over time. Around the same period, Modigliani developed the life cycle hypothesis, which explains how individuals plan their spending and saving throughout their lives. Understanding these theories helps us grasp the foundations of modern economic thought. The correct answer here is A. Let's look at a key figure in endogenous growth theory, the idea of learning by doing from 1962. This concept highlights how productivity improves as we gain practical experience over time. The question here is, who introduced this idea? Was it Robert Solow, Kenneth Arrow, Paul Romer, or Robert Lucas? Each of these economists made important contributions, but only one is closely linked to this particular concept. Let's explore who that is. Let's dive into a key concept introduced by Kenneth Arrow back in 1962, learning by doing. This idea became a foundation for what we call endogenous growth models. In simple terms, it means that as we work and practice, we get better, and that improvement actually drives economic growth from within the system itself. This insight helped shape how economists understand growth over time. The correct answer here is C. Let's look at an important question in economic thought. Who proposed the theory of immiserizing growth back in 1858? This idea challenges the usual assumption that economic growth always benefits a country. Instead, it suggests growth can sometimes make a nation worse off. The options here include notable economists, Dadabhai Naoroji, Mahbub-ul-Haq, Amartya Sen, and Jagdish Bhagwati. Think about who first introduced this counterintuitive concept. Let's dive into the idea of immiserizing growth, introduced by Jagdish Bhagwati. It's a surprising concept, growth that actually makes a country worse off. How? When growth causes the terms of trade to worsen so much that the gains from growth are wiped out. Instead of prosperity, the country faces a decline in welfare. It's a powerful reminder that growth alone isn't always enough. The quality and context matter just as much. Now, let's look at a key figure in Indian economic history. The question asks who wrote The Poverty and Un-British Rule in India back in 1901. We're choosing from four notable economists, Manmohan Singh, Dadabhai Naoroji, V.K.R.V. Rao, and R.C. Dutt. This question helps us connect important economic critiques with their authors, a crucial step in understanding the intellectual resistance to colonial rule. Think about who among these voices challenged British policies most directly at that time. Let's take a closer look at Dadabhai Naoroji, a key figure known for his drain theory. In 1901, he wrote a book that sharply criticized colonial economic policies. This work laid out how wealth was being extracted from colonies, impacting their development. Understanding this helps us see why answer C is the correct choice here. It ties directly to Naoroji's influential critique. Now, let's look at the big push theory of development. This theory suggests that economic progress requires a large, coordinated effort, a big push, rather than small, isolated steps. The question here is, who first proposed this idea? The options include Gunnar Myrdal, Harvey Leibenstein, Ragnar Nurks, and Paul Rosensteinrodden. Keep these names in mind as we explore the origins of this influential development theory. Let's dive into the big push theory, proposed by Rosensteinrodden back in 1943. The core idea is simple but powerful. Large-scale investment is needed to kickstart development. It's not about small steps, but a big, coordinated effort to overcome initial barriers. This approach suggests that only a substantial push can set the wheels of growth turning effectively. That's why the correct answer here is A. Let's look at question 47, which asks about the Stolper-Samuelson theorem from 1941. This theorem is a key concept in economics, and the question wants us to identify which field it belongs to. Is it public finance, international trade, microeconomics, or welfare economics? We'll explore how this theorem fits into the bigger picture of economic theory and why it matters. Let's take a closer look at this important theorem, introduced by Wolfgang Stolper and Paul Samuelson back in 1941. It explains how shifts in the prices of what we produce directly affect the rewards earned by the factors of production, like labor and capital. Understanding this link helps us see how economic changes ripple through to wages and returns. On this slide, the correct answer is option B, which captures that relationship most accurately. Let's take a moment to focus on a key figure in economic history. The question asks, who wrote The Wealth of Nations back in 1776? This work laid the foundation for modern economics, introducing ideas about free markets and the division of labor. Among the options, John Stuart Mill, Thomas Malthus, Adam Smith, and David Ricardo. Only one is the author of this landmark book. Keep that in mind as we move forward. Let's take a closer look at Adam Smith's landmark work, The Wealth of Nations, published in 1776. This book laid the groundwork for classical economics, shaping how we understand markets, trade, and wealth creation. It's often seen as the starting point for economic theory as we know it today. This slide highlights its importance and confirms it as the correct answer in our discussion. Let's talk about the life cycle hypothesis. This idea helps us understand how people plan their spending and saving over their lifetime. But who came up with it? The main economist behind this theory is Franco Modigliani. He explored how individuals smooth out their consumption, balancing income and expenses from youth to retirement. So, when you think about the life cycle hypothesis, Remember Modigliani's name, he's the key figure here. Let's dive into the life cycle hypothesis, developed by Franco Modigliani and Albert Ando in the early 1950s. This idea helps us understand how people plan their spending and saving over their entire lifetime. Instead of focusing on income at any single moment, it looks at the whole picture, from working years to retirement. This concept has shaped how economists think about personal finance and consumption behavior ever since. Let's take a moment to consider a key idea in economics, the relationship between income inequality and economic growth. This question asks who introduced the inverted U hypothesis, which suggests that inequality first rises and then falls as an economy develops. The options include Nicholas Kaldor, Amartya Sen, Thomas Piketty, and Simon Kuznets. The answer we're looking for is Simon Kuznets, who first proposed this concept. Let's dive deeper into Simon Kuznets' inverted U hypothesis from 1955. He suggested that as a country develops, inequality first rises, then eventually falls, forming a curve shaped like an upside-down U. This slide also introduces the next batch of multiple-choice questions, focusing on government schemes. We'll explore questions 51 through 100, each with 4 options and detailed explanations to help us understand the material better. The correct answer here is option A. Let's look at a key date in India's recent history. The question here asks when the Digital India Initiative was officially launched. It's a multiple-choice question with 4 options, spanning from 2014 to 2016. This initiative marked a major push to transform India into a digitally empowered society and knowledge economy. Knowing the exact launch date helps us understand the timeline of this ambitious program and its impact on the country's development. Let's dive into the Digital India Initiative, launched on July 1, 2015. The main goal was clear: to bring high-speed internet to every corner of the country. But it wasn't just about connectivity. It also aimed to boost digital literacy, making sure people could actually use the technology once it was there. This initiative set the stage for a more connected, empowered India. Let's talk about the PM Fasal Bima Yojana, or PMFBY, launched back in 2016. This scheme offers insurance coverage for farmers, but the question is, what exactly does it cover? Is it just fire-related damages, only drought-related losses, pest infestations alone, or does it include a broader range of risks like natural calamities, pests, and diseases? Understanding the scope of this insurance helps us see how it supports farmers against multiple threats to their crops. Let's dive into the details of PMFBY, the Pradhan Mantri Fasal Bima Yojana. This scheme offers thorough crop insurance, covering all natural risks that farmers can't prevent. That means natural disasters, pests, and diseases are all included. It's been in effect since the 2016 Kharif season, providing a safety net when things go wrong. This comprehensive coverage is what makes PMFBY a crucial support system for farmers across the country. Let's look at a question focused on skill development schemes. It asks which program, launched in 2017, aims to build capacity and provide training specifically in the textile sector. Among the options are PM UMED, Samarth Scheme, Startup India, and the NIRVIK scheme. This question tests our understanding of targeted initiatives designed to boost skills in key industries, helping us connect policy names with their specific goals. Let's take a closer look at the Samarth scheme. Launched in 2017 by the Ministry of Textiles, this initiative focuses on skill development and boosting employment within the textile industry. It's designed to equip workers with the right skills, making the sector more competitive and sustainable. This scheme plays a key role in strengthening the textile workforce, ensuring they're ready for the evolving demands of the market. Let's focus on the primary goal of the POSHAN Abhiyan, or National Nutrition Mission, launched in 2018. This initiative is all about tackling malnutrition in India. Its main objective is to reduce stunting, undernutrition, and anemia among children, women, and adolescent girls. While other efforts like financial literacy or clean water are important, POSHAN Abhiyan zeroes in on improving nutrition to build a healthier future for the nation. Let's take a closer look at POSHAN Abhiyan, launched on March 8, 2018. This initiative targets a big challenge, reducing stunting in children, aiming to bring it down from 38.4% to 25% by 2022. Alongside that, it focuses on tackling undernutrition and anemia, critical issues affecting child health and development. This program represents a focused effort to improve nutrition outcomes across the country. Let's talk about the health cover provided under the Ayushman Bharat Pradhan Mantri Jan Arogya Yojana. The question here is, how much financial protection does each family get per year? The options range from 2 lakh rupees up to 10 lakh rupees. This scheme is designed to offer significant support for healthcare expenses, helping families access treatment without financial strain. Understanding this amount is key to grasping the impact of the program on public health. Let's break down the details of this health coverage scheme. It offers a safety net of 5 lakh rupees per family every year. This isn't just any coverage, it specifically supports secondary and tertiary care hospitalization. That means it steps in when more advanced medical treatment is needed, beyond basic care. Understanding this helps us see why option C is the correct answer here. Let's take a moment to focus on the official launch date of the PM Kisan scheme. This question asks us to identify when the program was inaugurated. It's important because knowing the start date helps us understand the timeline of its impact and development. The options range from late 2018 to early 2020, each a key moment in recent agricultural policy. Keep these dates in mind as we explore the scheme's progress. Let's take a closer look at the timeline here. The scheme actually began on the 1st of December, 2018. But it wasn't until nearly 3 months later, on the 24th of February, 2019, that the Prime Minister officially inaugurated it. This distinction is important. The start date and the formal launch don't always line up. Understanding this helps us grasp the full context of the initiative's rollout. Let's look at how a marginal farmer is defined for eligibility in certain programs. The options range from owning no land at all to owning up to 5 hectares. Specifically, the categories include owning up to 1 hectare, 2 hectares, or 5 hectares. Understanding this definition helps us identify who qualifies for support under these schemes, ensuring aid reaches those who need it most. Let's clarify the difference between marginal and small farmers. Marginal farmers are those who own up to 1 hectare of land. Small farmers, on the other hand, have land holdings up to 2 hectares. This distinction helps us understand the scale of farming operations and the challenges each group faces. In this case, the correct answer identifies these definitions clearly: marginal farmers with up to 1 hectare, small farmers up to 2. Let's take a look at a quick quiz question. It asks, the Catch the Rain campaign is part of which government initiative? You'll see 4 options here: Swachh Bharat Mission, Jal Shakti Abhiyan, AMRUT, and PM Sinchai Yojana. This question helps us connect specific campaigns to their broader programs, deepening our understanding of how these initiatives work together to manage water resources effectively. Let's take a closer look at the Jal Shakti Abhiyan, launched in 2019. This campaign zeroed in on water conservation and security, aiming to address critical water challenges. One of its key initiatives was Catch the Rain, encouraging communities to harvest and store rainwater effectively. This approach not only conserves water, but also strengthens local water resources. It's a powerful example of how targeted efforts can make a real difference in managing our most precious resource. Let's take a closer look at the Vivad Se Vishwas scheme, introduced in 2020. This initiative was designed to resolve disputes, but what kind of disputes exactly? The options here include land ownership in villages, direct taxes, indirect taxes like GST, and international trade tariffs. Understanding the focus of this scheme helps us see how the government aimed to simplify and settle tax-related conflicts efficiently. It's a key part of modernizing dispute resolution in the tax system. Let's take a closer look at this scheme, which was introduced on February 1st, 2020. Its main goal was to clear up unresolved direct tax disputes that were still hanging around. By focusing on these pending issues, the scheme aimed to provide clarity and resolution for taxpayers and authorities alike. This approach helped reduce backlog and brought more certainty to the tax process. It's a targeted solution for a specific challenge in the tax system. Let's look at a key question about the Production-Linked Incentive Scheme. This initiative was designed to give a major boost to one specific sector. The options we have are agriculture exports, domestic manufacturing, digital education, and rural healthcare. Think about where the government's focus lies when it comes to driving production and growth. The right choice reveals a lot about the priorities behind this scheme. Let's take a closer look at the PLI scheme, launched back in March 2020. Its main goal is to boost manufacturing within India, cutting down on the country's reliance on imports. But it's more than that. This initiative is designed to position India as a global manufacturing powerhouse. By encouraging local production, the scheme hopes to create jobs, strengthen the economy, and make India a key player on the world stage. This is the core idea behind the PLI scheme. Let's look at a question about government schemes that use technology in rural areas. Specifically, which one uses drones to map land parcels and issue property cards? This initiative combines innovation with practical benefits for farmers and landowners. It's a great example of how digital tools are transforming traditional processes, making land records more accurate and accessible. Think about the impact this could have on rural communities and property rights. Which scheme do you think fits this description? Let's dive into the SVA-MITVA scheme, which started on April 24, 2020. This initiative uses drones, yes, drones, to map village properties accurately. The goal is simple but powerful: to give homeowners in villages official records of their property ownership. This approach not only modernizes land records, but also empowers rural communities with clear, legal proof of ownership. It's a smart blend of technology and governance that's changing how property rights are managed. Let's focus on the target year for the Insurance for All goal, set by IRDAI. The options range from 2030 to 2047, with key milestones in between. This question helps us understand the timeline envisioned for achieving universal insurance coverage. Knowing the right year gives us insight into the urgency and planning behind this important initiative. Let's dive into a detailed explanation of IRDAI's ambitious goal: achieving insurance coverage for everyone by 2047. This vision is backed by key initiatives known as the Bima Trinity. These include Bima Vahak, Bima Vistar, and Bima 2, each playing a vital role in expanding access and affordability. Together, they form a comprehensive strategy to bring insurance to all corners of the country, ensuring no one is left behind. Let's look at a question about the Pradhan Mantri Matsya Sampada Yojana, or PMMSY. This initiative focuses on boosting growth in a specific sector. Your options include milk production, fisheries, silk farming, and organic fertilizers. Think about which of these areas the scheme aims to develop. It's a key program designed to strengthen livelihoods and resources in that targeted field. Let's take a closer look at this initiative launched in May 2020. Its main goal is to boost the fisheries sector, an important part of India's economy, contributing around 1% to the GDP. Though it might seem small, this sector supports many livelihoods and has significant growth potential. Understanding this scheme helps us see how targeted efforts can strengthen key industries and drive broader economic benefits. Let's look at the groups that benefit from the PM-SVA NITI scheme. This program offers special microcredit facilities, but who exactly does it serve? The options include tribal students, self-help groups, street vendors, and small-scale exporters. Understanding which group receives this support is key to grasping the scheme's focus on empowering small entrepreneurs and boosting livelihoods at the grassroots level. Keep this in mind as we explore the answer. Let's take a closer look at PM-SVA NITI, the Street Vendors Atma Nirbhar NITI. It was launched on June 1, 2020, specifically to support street vendors who faced financial challenges during the COVID-19 pandemic. The initiative provides them with much-needed loans to help restart their businesses and regain stability. This program is a crucial part of the broader effort to empower small entrepreneurs in tough times. Let's look at the timeline for the One Nation, One Ration card scheme. When exactly was it officially launched? The options span from 2014 to 2022, with key years in between. This question helps us pinpoint the moment this important initiative began, aiming to unify the ration card system across the country. Keep these dates in mind as we explore how ONORC has evolved and impacted food security since its launch. Let's take a closer look at the ONORC scheme, which was introduced in August 2020. Its main goal is to create uniform ration cards that work across all states. This means no matter where you go, your ration card will be recognized and accepted. It's a big step towards simplifying access to essential resources for everyone, making the system more efficient and user-friendly. Let's look at a key part of India's energy future, the National Hydrogen Mission, launched in early 2022. Its goal is bold, to position India as a global hub for hydrogen production and use. This slide asks which type of hydrogen or related fuel the mission focuses on. Understanding these options helps us see where India's priorities lie in the clean energy transition. It's a crucial step toward a sustainable, low-carbon future. Let's dive into the mission launched in February 2022. Its goal is clear, to make India a global leader in green hydrogen production. This isn't just about energy. It's about shifting away from fossil fuels and building a cleaner, more sustainable future. The focus is on innovation and scaling up technologies that reduce our carbon footprint. This initiative marks a major step toward energy independence and environmental responsibility. Let's look at a key moment in agricultural technology. The question asks when the Kisan Drone Yojana was launched to boost farming with new tech. We have 4 options, spanning from early 2022 to March 2024. This initiative marks a significant step in integrating drones into agriculture, aiming to improve efficiency and productivity. Knowing the exact launch date helps us understand the timeline of tech adoption in farming. Think about which date fits best with recent developments in this field. Let's dive into the Kisan Drone Yojana, a new program started in March 2024. Its goal is simple but powerful, to encourage farmers to use drones for monitoring their crops and spraying pesticides. This initiative aims to boost efficiency and precision in agriculture, helping farmers save time and resources while improving yields. It's a step toward modernizing farming with technology that's already changing how we grow food. Let's look at who the Sankalp See City scheme aims to empower. This program, launched in January 2023, targets specific groups to boost their opportunities and support. Is it only farmers in drought-prone areas, youth and women in both rural and urban settings, small-scale industrialists alone, or just senior citizens? Understanding the focus of this initiative helps us see how it drives inclusive growth and empowerment. This slide dives into a specific initiative launched in January 2023. The focus here is clear, empowering youth and women by fostering entrepreneurship and developing skills. It's about creating opportunities where they can grow, lead, and innovate. This approach recognizes the power of targeted support to unlock potential and drive real change in communities. The correct answer here highlights the core goal of this scheme: empowerment through practical, hands-on development. Let's take a closer look at PMWANI, a key part of expanding wireless connectivity. Launched in December 2020, PMWANI stands for Public Wi-Fi Access Network Interface. It's designed to make public Wi-Fi more accessible and easier to use across the country. This initiative aims to integrate various wireless networks, both public and private, creating a seamless experience for users. Understanding this term is essential as we explore how wireless access is evolving today. Let's dive into what PMWANI really means. It stands for Public Wi-Fi Access Network Interface. The goal here is simple: to boost wireless connectivity across public spaces. By doing this, it makes everyday life easier, whether you're working, studying, or just staying connected on the go. This initiative is all about expanding access and improving convenience for everyone. Let's look at a key question about the Atmanirbhar Bharat Rojgar Yojana. This scheme targeted states that were hit hard by COVID-19's economic impact. Among the options, Gujarat, Bihar, Kerala, and Tamil Nadu were asked to identify which state was initially covered under this program. Understanding this helps us see how the government prioritized support where it was needed most during the pandemic's early days. Let's take a closer look at where employment schemes first took root after the pandemic. States like Bihar, Uttar Pradesh, Madhya Pradesh, Rajasthan, Jharkhand, and Odisha were the initial focus. These regions saw targeted efforts to boost job opportunities and support livelihoods. Understanding this helps us see how the response was shaped by local needs and challenges, setting the stage for broader initiatives that followed. Let's look at the original focus of the Make in India initiative. The question here asks how many sectors were included at the start. The options range from 10 to 50 sectors. This helps us understand the scope and ambition behind the program when it first launched, how broad or targeted the government's approach was in boosting manufacturing and investment. It's a key point in grasping the initiative's early strategy. Let's take a closer look at the Make in India initiative. Launched in 2014, it targets 25 specific sectors, aiming to boost manufacturing and innovation across the country. This initiative isn't just broad, it's focused, with clear goals to transform India into a global manufacturing hub. Understanding these sectors helps us see where the biggest opportunities and challenges lie. Let's look at the premium rates for the PM Jeevan Jyoti Bima Yojana, the life insurance scheme. The question asks us to identify the correct annual premium from 4 options. They range from as low as 12 rupees to as high as 500 rupees per year. This helps us understand the affordability and accessibility of the scheme for the general public. Keep these figures in mind as we explore how the program supports financial security. Let's break down the costs here. The accidental insurance, called Suraksha Bima, costs just 12 rupees. In contrast, the life insurance, Jeevan Jyoti Bima, carries a higher annual premium of 330 rupees. This difference is important to understand when choosing the right coverage. So the correct answer to this question is option C, reflecting the distinct premiums for each insurance type. Let's look at the NIRVIK scheme, a key initiative aimed at boosting exports through enhanced credit insurance. The question here asks us which organization implements this scheme. The options include RBI, SEBI, ECGC, and NABARD. As we explore this, keep in mind the roles these institutions play in India's financial and export sectors. This will help us identify the right answer with confidence. Let's take a closer look at the NIRVIK scheme, which stands for Nuriyat Rin Vikas Yojana. This initiative is designed specifically for exporters, aiming to support their financial needs. Importantly, it's implemented under the Export Credit Guarantee Corporation, or ECGC. This connection helps ensure exporters get the credit and insurance they need to grow confidently in international markets. Understanding this link is key to grasping how export financing works in this context. Let's look at when the PMCARES for Children scheme was launched. This initiative supports children orphaned by COVID-19, a critical response to the pandemic's impact. The question asks us to identify the exact launch date from 4 options, spanning from April 2020 to August 2021. Understanding this timeline helps us see how quickly support systems were put in place during the crisis. This slide gives us a detailed explanation of a support scheme launched on May 29, 2021. Its purpose was to help children who lost their parents during the pandemic. This initiative was a crucial response to a heartbreaking situation, aiming to provide care and stability when it was needed most. Understanding the timing and intent behind this scheme helps us appreciate its role in the broader effort to support vulnerable families. Here, we're looking at a question from the MCQ educational presentation focused on the Bima Trinity. The question asks us to identify the third component alongside Bima Vahak and Bima Vistar. The options listed include Bima Wealth, Bima Jeevan, Bima 2, and Bima Suraksha. This slide challenges us to recall the key elements that make up this important trio. Let's dive into the heart of the Bima Trinity, launched on April 25, 2025. It's made up of 3 key components: Bima Vahak, Bima Vistar, and Bima. Each plays a distinct role in the system, working together to create a comprehensive solution. Understanding these parts helps us see how the whole initiative fits together and why it's designed the way it is. Let's take a moment to focus on a key date in legal history. The question asks, when was the Indian Contract Act passed? We have four options here: 1860, 1872, 1881, and 1913. This act laid down the foundation for contract law in India, shaping how agreements are made and enforced. Knowing the correct year helps us understand the timeline of legal development in the country. So, which year do you think it is? Let's dive into a key detail. The Indian Contract Act was enacted in 1872. That's the same year India began its first census process. This connection helps us place the act in a broader historical context. Understanding when it was established gives us insight into the legal and administrative changes happening at that time. So the correct answer here is B, 1872. Let's look at an important moment in labor history, the Trade Union Act. This law marked a big step for workers' rights and collective bargaining. The question is, when was it passed? Was it 1913, 1923, 1934, or 1947? Each of these years tells a different story about the evolution of labor laws. Understanding the right date helps us see how labor movements gained legal recognition over time. Let's take a closer look at the Trade Union Act of 1923. This law was introduced to regulate labor unions, setting clear rules around their operation. It was a key step in shaping how unions could organize and represent workers. Understanding this act helps us see the framework that governs labor relations even today. The correct answer here is B, confirming that the Trade Union Act focused on union regulation. Let's take a moment to focus on a key date in financial history. The question here is about the year the Banking Regulation Act was passed. We have four options: 1934, 1948, 1949, and 1955. This act laid the foundation for regulating banks and ensuring stability in the financial system. Think about which year fits best with the broader timeline of banking reforms. It's an important milestone to remember. Let's take a closer look at the Banking Regulation Act. It was passed in 1949, the very same year the Reserve Bank of India was nationalized. This connection is important because it marked a major shift in how banking was overseen and controlled in the country. Understanding this timeline helps us see why the correct answer here is option C. It's all about the historical context shaping modern banking regulations. Here, we're looking at a question about the Planning Commission of India, specifically, when it was established and when it was dissolved. The options span from the late 1940s to the 2010s, reflecting key moments in India's development. This question tests our knowledge of important institutional timelines, a way to connect history with governance and policy changes over time. Let's explore which dates best capture the lifespan of this influential body. Let's take a closer look at the Planning Commission. It was established back in 1950 and played a key role in shaping economic policies for decades. But in 2014, it was dissolved, making way for a new institution, NITI Aayog, which officially started on January 1, 2015. This shift marked a significant change in how planning and development were approached in the country. Now, let's test what we've learned with a quick question. In which year was the first Finance Commission Act passed? The options are 1948, 1950, 1951, and 1955. Think about the history we've covered so far. This will help us anchor the timeline of financial governance and its evolution. Take a moment to consider your answer before we move on. Let's take a closer look at the Finance Commission. It was set up after the 1951 Act with a clear purpose: to manage the financial relationship between the central government and the states. This body plays a crucial role in deciding how resources are shared, ensuring balance and fairness across different levels of government. Understanding this helps us grasp the bigger picture of fiscal federalism in action. The correct answer here is C. Let's look at a key piece of legislation often mentioned in discussions about price control, the Essential Commodities Act. The question here asks us to identify the year it was passed. The options range from 1951 to 1980, covering a few decades of important economic changes. Understanding when this act came into force helps us see how the government has tried to regulate essential goods over time. Keep this in mind as we explore its impact further. Let's take a closer look at the Essential Commodities Act. Passed back in 1955, it's still a crucial tool the government uses to step in and regulate markets when needed. This act helps control the supply, pricing, and distribution of essential goods, ensuring stability and protecting consumers. Understanding this law is key to grasping how market interventions work in practice. The correct answer here is B. Let's look at a key moment in financial history, the year the Unit Trust of India Act was passed. This question asks us to pinpoint the exact year, with options ranging from 1955 to 1969. Understanding when this act came into effect helps us see how collective investment schemes began shaping India's economy. It's a small detail, but an important one in the bigger picture of financial regulation and growth. Let's take a closer look at the UTI Act, passed in 1963. This law was a major milestone. It essentially launched the mutual fund industry in India. Before this, the idea of pooling investments in a regulated way was just starting to take shape. The act set the foundation for how mutual funds would operate, shaping the market we know today. Understanding this helps us see how the industry evolved from its very beginning. Let's take a moment to focus on the Asian Development Bank, or ADB, and where its headquarters are located. This question asks us to identify the city that has been home to the ADB since it was established in 1966. We have 4 options: Tokyo, Beijing, Manila, and Washington. Think about the region the bank serves and its mission. This will help us pinpoint the correct answer. Let's take a closer look at the Asian Development Bank, or ADB. It was established back in 1966, and its headquarters are in Manila, Philippines. This detail helps us understand the bank's origins and where it operates from. Knowing this sets the stage for deeper insights into its role and impact across the region. Let's look at an important question about Indian economic laws. The Foreign Exchange Regulation Act, or FERA, was passed back in 1973, but it didn't stay on the books forever. It was eventually replaced by a newer law. This question asks us to identify which act took its place. The options include SEBI, FEMA, MRTP, and the Competition Act. Understanding these laws helps us grasp how foreign exchange and economic regulations have evolved over time. Let's take a closer look at the evolution of foreign exchange regulation in India. The Foreign Exchange Regulation Act, or FERA, was introduced in 1973. It was quite restrictive, aiming to control foreign exchange tightly. However, by 1999, it was replaced by FEMA, the Foreign Exchange Management Act. FEMA took a more liberal approach, focusing on facilitating external trade and payments rather than strict regulation. This shift marked a significant change in how foreign exchange was managed. Let's take a moment to focus on a key milestone in business development, the Micro, Small and Medium Enterprises Development Act. This question asks us to identify the year it was passed. The options range from 1992 to 2006. Understanding when this act came into effect helps us see how support for smaller businesses has evolved over time. It's a crucial piece in the puzzle of economic growth and entrepreneurship. Let's take a closer look at the MSME Act, which was enacted back in 2006. This law sets the definitions for micro, small, and medium enterprises, but those definitions haven't stayed fixed. They've been updated periodically to reflect changing economic realities. Understanding these shifts is key to grasping how the Act supports businesses today. This slide is part of a broader discussion on economic theories, helping us connect policy with practical impact. The correct answer here is option D. Let's dive into a key moment in economic history, Augustin Cournot's model of duopoly. This model laid the groundwork for how we understand competition between 2 firms in a market. The question is, when was this cornerstone of microeconomics introduced? Was it 1776, 1817, 1838, or 1890? Think about the timeline and the evolution of economic thought as we explore this important concept. Let's take a closer look at the Cournot model. It's a classic approach where firms compete by choosing how much to produce, rather than setting prices. This model dates all the way back to 1838, making it one of the earliest formal theories in economics. Understanding this helps us see how companies might behave when they're rivals in the same market, each deciding their output while considering what others do. It's a cornerstone for analyzing competition today. Let's take a moment to consider Edward Chamberlain's theory of monopolistic competition. The question is, when was this influential work published? Was it 1920, 1933, 1939, or 1944? This theory reshaped how we think about markets that aren't perfectly competitive, and knowing the year helps place it in its historical context. Think about the economic environment of the time as you decide. Let's take a closer look at monopolistic competition. In 1933, two economists, Chamberlain and Joan Robinson, independently published key works that laid the foundation for this concept. Their ideas helped us understand markets where many firms sell similar, but not identical, products. This slide highlights their contributions and points us to the correct answer, which is option B. It's important to recognize their role in shaping modern economic theory. Let's look at a key moment in the history of game theory. John Nash introduced the concept now known as the Nash equilibrium. When did this happen? The options range from the late 1920s to the early 1970s. This question helps us pinpoint the era when Nash's groundbreaking ideas first shaped how we understand strategic decision-making. It's a crucial piece of the puzzle in the evolution of economics and mathematics. Let's take a closer look at the history behind game theory. Although the field itself was formalized back in 1944, it was John Nash who really changed the game. Around 1950 and 1951, he introduced his famous equilibrium concept. This idea has since become a cornerstone in understanding strategic decision-making. It's a key moment that helped shape how we analyze interactions in economics, politics, and beyond. Let's take a moment to look at a key figure linked to the optimum population theory from 1922. This theory explores the ideal population size for a given region, balancing resources and growth. The question asks us to identify who is most closely associated with this idea. We'll consider 4 names: Thomas Malthus, Carl Saunders, Karl Marx, and Simon Kuznets, and see which one fits best with this concept. Let's dive into the optimum population theory, introduced back in 1922 by Carl Saunders and his colleagues. This idea came as a fresh alternative to the more familiar Malthusian perspective on population growth. Instead of focusing solely on limits and scarcity, it explores the ideal population size that balances resources and social well-being. Understanding this theory helps us rethink how population dynamics influence economic and social development. The correct answer here is B. Let's take a moment to focus on the economist who popularized the purchasing power parity theory back in 1916. This theory helps us understand how exchange rates adjust based on the relative prices of goods between countries. The question here asks us to identify which of these 4 economists brought this idea into the spotlight. It's a key moment in economic history, linking currency values to purchasing power across borders. Let's dive into the PPP theory, proposed by Gustav Cassel back in 1916. This theory helps us understand how exchange rates move over time. Essentially, it suggests that currency values adjust to reflect changes in price levels between countries. It's a foundational idea in international economics, giving us a way to predict long-term currency trends. Today, we're focusing on this concept to better grasp how exchange rates respond to economic shifts. Let's look at a key question about the absorption approach to the balance of payments, introduced in 1952. This approach helps us understand how a country's spending and income relate to its international trade balance. The question asks, who developed this idea? We have 4 economists to consider: Sidney Alexander, Robert Mundell, Paul Samuelson, and J.M. Keynes. Each made important contributions, but only one is credited with this specific approach. Let's explore who it was. Let's take a closer look at the absorption approach, introduced by Sidney Alexander back in 1952. This approach zeroes in on the connection between a country's real income and its spending. It helps us understand how much of the income generated is actually absorbed through expenditure. This idea plays a key role in analyzing economic balance and trade flows. Understanding this relationship gives us a clearer picture of economic health and policy impact. Let's look at the timeline for the Harrod-Damar growth model. This question asks us to pinpoint when it was first formulated. We have 4 options spanning from the early 1930s to the mid-1960s. The model itself is a foundational concept in economic growth theory, so knowing its historical context helps us understand its development and impact. Think about the global economic conditions during these periods. They're clues to when this model emerged. Let's take a closer look at the Harrod-Damar model. It's all about capital accumulation, how investment drives economic growth. This model was developed independently by 2 economists, Roy Harrod in 1939 and F.C. Damar in 1946. Their work laid the foundation for understanding growth dynamics, especially in developing economies. So when we talk about this model, we're focusing on how saving and investment fuel expansion over time. The correct answer here is B. Let's look at a key concept in development economics, the vicious circle of poverty. This idea helps explain why some economies struggle to grow. The question here asks who proposed this concept back in 1953. Among the options, we have Gunnar Myrdal, Arthur Lewis, Ragnar Nurks, and W.W. Rostow. Understanding who introduced this idea gives us insight into how economists have tried to break down persistent poverty traps. It's a foundational piece in thinking about economic development. Let's take a closer look at this idea. Ragnar Nurks introduced this concept back in 1953 to explain a tough economic puzzle, why some poor countries stay poor. His argument centers on the fact that low levels of savings and investment create a cycle that's hard to break. Without enough capital, these countries can't grow, and without growth, they can't save more. It's a classic example of how economic challenges can reinforce themselves. Let's take a moment to look at a key milestone in economic theory, Robert Solow's exogenous growth model. This model reshaped how we understand economic growth over time. The question is, when was it published? Was it 1946, 1950, 1956, or 1960? Think about the era and the context of economic thought back then as you consider your answer. Let's take a closer look at Robert Solow's key contribution to economic growth theory. Back in 1956, he highlighted the crucial role of technological progress, showing how it drives long-term growth beyond just labor and capital. This insight reshaped how economists understand development. So, when we talk about what really fuels sustained growth, Solow's emphasis on technology is central. That's why the correct answer here is C. Gary Becker's work on human capital is a cornerstone in economics. But when exactly was it published? Was it in 1957, 1964, 1971, or 1980? This question invites us to think about the timeline of ideas that shaped how we understand education, skills, and economic growth. Take a moment to consider which year fits best with Becker's influential contribution. Let's take a closer look at a key moment in economic thought. In 1964, Gary Becker published his groundbreaking work on human capital. This idea reshaped how we think about education, skills, and investment in people. It showed us that people's knowledge and abilities are valuable assets, just like physical capital. Understanding this helps us see why investing in ourselves and others matters so much. Let's look at a key moment in economic thought, Paul Romer's endogenous growth model. This model, which highlights the role of knowledge and ideas in driving growth, was a major shift. The question is, when was it published? Was it 1980, 1986, 1990, or 2000? Understanding the timing helps us see how economic theories have evolved over the past few decades. Let's take a closer look at Paul Romer's work. In 1986, he introduced a groundbreaking model that changed how we think about economic growth. It's called the endogenous growth model. Unlike earlier theories, it explains growth coming from within the economy itself, driven by ideas, innovation, and knowledge. This slide highlights that key moment, reminding us why Romer's work remains central to understanding how economies evolve over time. Let's take a moment to think about when the Human Development Index, or HDI, was first launched by the United Nations Development Program. This question asks us to pick the right year from 4 options: 1980, 1985, 1990, or 1995. The HDI is a crucial measure that helps us understand human progress beyond just economic growth. So, which year do you think marks its debut? Let's take a closer look at the Human Development Index, or HDI. It was introduced back in 1990. Thanks to the work of Mahbub-ul-Haq and Amartya Sen, their goal was to create a measure that goes beyond just economic growth, focusing instead on human well-being and capabilities. This slide highlights the correct answer to a question about the HDI's origins, emphasizing its thoughtful development by these two influential economists. Let's talk about the drain theory, a key idea in understanding India's economic history under British rule. This theory explains how wealth was taken out of India and sent to Britain, impacting the country's development. The question here is, who first proposed this theory? The options include G.K. Gokhale, M.G. Ranade, Dadabhai Naoroji, and R.C. Dutt. It's an important point to know, as it highlights early economic critiques of colonialism. Let's take a closer look at Dadabhai Naoroji and his important contribution. He's the author of the drain theory, which he laid out in his 1901 book, Poverty and Un-British Rule in India. This theory explains how wealth was being taken out of India under British rule, causing lasting economic harm. Understanding this helps us grasp the economic impact of colonialism from an Indian perspective. The correct answer here is B. Let's take a look at a key question about India's second five-year plan. This plan was guided by a specific growth model, developed by one of four influential economists. Each played a role in shaping economic thought, but only one's model formed the foundation for this plan. Understanding who that was helps us grasp the plan's priorities and approach to development. So, which economist's growth model was it? Let's take a closer look at the second five-year plan, which ran from 1956 to 1961. This plan was built around the Mahalanobis model, a strategy that focused heavily on developing heavy industry. It wasn't just about growth, but about laying a strong industrial foundation for the future. Understanding this approach helps us see why certain sectors were prioritized during that period. The correct answer here is B. Let's take a moment to look back at the decades and think about when Amartya Sen capability approach really came into the spotlight. This idea, which reshaped how we think about welfare and development, gained prominence in one of these 4 decades: the 1960s, 1970s, 1980s, or 2000s. It's a key milestone in social and economic thought, so consider which era best fits this groundbreaking shift. As we wrap up, remember that Amartya Sen's capability approach, introduced in the 1980s, shifts the focus to what people are truly able to do and be. It's about real opportunities, not just resources or outcomes. This perspective helps us think deeper about well-being and justice. That's the core idea here.